Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Good morning. It's a quick research update from the team here on May 28th. Just going to go over a real quick contrarian cap, and then we'll spend a bit of time on our latest portfolio company. It's called Boom. It's a prop tech real estate company, and no charts of the week. Andrew's on vacation, and then in light of that, we'll do a skill testing question called "Who has more money?" And so the disclaimer, as always. So contrarian cap is our distressed debt specialist in the emerging markets. Looks like they're up to a pretty good year, 10.32% year to date until the end of I think that's April, and then the monthly return is another 32 basis points on top of that net. So all good things from contrarian. This is just sort of a look at the exposure. So the summary at the top is really, long, short, net, gross, and then the top positions, obviously concentrated around corps and sovereigns in terms of the allocation. And then country-wise, it's primarily Venezuela, Brazil, and Argentina. Are sort of the lion's share of the regional exposure, which makes sense. Those are the biggest economies in that particular listing. Would have thought actually that Chile would be on here and some of the stuff going on there in terms of mining and other areas, but it is what it is. And then in terms of the sector exposure, that sovereign category is tricky because you got to kind of dive into that a little bit. And if you did, the oil and gas would go up for sure, but so would some of the telco and airline and infrastructure and steel areas. Those are sort of the bigger government areas. And then top 10 holdings would be the Republic of Venezuela, which isn't a surprise given the regional exposure. Ditto for Buenos Aires, and then Digicel Investments is a telco company that I think we're gonna have to keep our eye on. It's a big holding and it's a big company, and it is making some progress here. Our own fiber optic cable investment in a company called Telmax. Kind of, started off slow and nothing, and then bang, all of a sudden they're starting to roll out fiber optic cable into places like Barrie and Richmond Hill, which is ahead of target. But these are the rest of the holdings. Some aircraft positions there as well. Looks like a finance bond for the aircraft industry there from Abra, and kind of the rest of the holdings there. Okay, so a couple of weeks ago, we made an investment in a startup, which we don't ordinarily do around here, but it is what it is. It's called Boom. It was founded by a guy called Rob Whiting, who's shown there, and then the website is boompay.app. The idea here is they report successful rent payment on the part of tenants to all three U.S. credit bureaus, thus allowing tenants that have a wanting to kind of, I guess, monetize their rent track record when they have their mortgage discussions at the bank. So it's actually a really good little piece of technology for the if you're a renter, and the asset owners and landlords love it as well because it stabilizes the net operating income of the property. So in other words, the top line of your income statement, your rents and stuff like that, tend to be a little bit smoother. And so, you can get a situation where you stabilize a property, maybe a little bit more, not necessarily quickly, but better, I guess is the word. And so this one really took off fast. These are the Q1 highlights. So they were way ahead of forecast in certain areas. So they call it a breakout quarter. I think that's fair. These are ARRs, so this is not stuff that's been collected, but it's sort of like extrapolated forward. But nonetheless, it's 4 times higher than it was this time last year and 33% ahead of target. So their annualized revenue run rate is it is $20 million because they came in to see me last Friday. It's more like 22 million as of right now. And their unit count was way ahead of what they thought it would be. So they're at like over 650,000 total units. And the explanation for why they beat so high is they landed a couple of large large apartment property portfolios that Rob and the team were credibly thinking they'd have a chance to land, but until it happens, you don't really know. And so they did close 81 new deals in the first quarter, which I don't even know how they did that, but I'm just glad that they did. And they have 350 customers, so that's a lot of buildings, that's a lot of units. And the revenues from all angles look pretty good. So they did a raise. So the end of the quarter, that the $12.5 million of cash on the balance sheet is from a raise that we participated in, and then I've approached the Rob, the founder, to see if I can grab us some more shares on a kind of in the back alleyway behind outside of office hours. But you got to go through your ROFR process and all that to see if there's even shares available. This particular raise was pretty hot. Like I think I had 2 days to decide on whether I could get this. And anyway, pretty excited because their burn rate's only 260 Gs per month, and so that means they should be cash flow positive. Maybe not around now, but like the thing I wrote down in my little duotang was like late July, and that's for all intents and purposes, like let's call it 60 days away. So this is a company that just started, okay, and they're already telling us that they're, a couple of months away from being sort of break even on the cash flow side, which is really good. And so they brought in a CFO to keep track of all the money. This is just sort of a comparison of the annualized revenue run rate versus their forecast and the quarterly data. So they thought they would hit about 14 million bucks, and again, they're now well over that 19.2 mark. In fact, they're in the 20s. So very pleased with this progress. And again, the unit count is, I mean, I don't want to kind of, pump this thing too much, but that unit count is really great, right? 665,000. This is well past, the point of just a great idea that someone had. Like these guys are clearly on a path to something. And you can see that average units per logo increasing by over 50%, which is really phenomenal. And then they outpaced their original projections. So this is just their annualized revenue run rate by the quarter. And they forecast that by the end of this year, they'll be walking around at around 32, 33 million. Sounds like they could even surpass that. So who knows? And then I don't know how they model this, but by the year-end 28 numbers, they figure they'll have about 130 million bucks in annualized revenues, which to me just screams exit. So I wouldn't be surprised. This company just sort of came out of nowhere. And the way it started, we talked about it once before, is that Rob, the founder, obviously comes from a tech and real estate background, but he noticed that during COVID, a lot of people that had housing challenges weren't able to I guess harness the value of being responsible for their rent. So this is a classic example of a tech play that I love. It's more like what you would call like rental compliance, if I could use that term, or something like that. Again, very, very heavily focused on credit, and scoring, and sort of building up your credit score. I love stuff like this because this is not, again, something that's sort of discretionary. This is sort of almost like a borderline need to have solution. So I just hope it continues. And then finishing off, we didn't do charts of the week. This one blew me away. So the question this week for the summer edition of Who Has More Money is Bad Bunny or Flow Rider. Now, talking about, kind of coming out of nowhere, I guess that's I mean, Bad Bunny was always doing stuff, but he really, I guess, became like a superstar kind of recently, whereas Flow Rider's been in the business for, I don't know, 15 years. And the answer is actually Bad Bunny's net worth is about double Flow Rider's, which is crazy because just going back to this thing, that $82 million lawsuit. So Flow Rider was helping promote some sports drink or something like that, like, where these young guys have their little squirt bottles and the drink is loaded with caffeine and has all sorts of fancy colors on it. So he promoted that and they didn't pay him for it. And so he sued the crap out of them, and the courts decided in Flow Rider's name. So I don't know if this more money includes his legal success. I mean, he's a great entertainer, but maybe he should consider becoming a lawyer. So that's it for me. I'll pass it back to you guys. Thanks.
Thanks, Joe. Okay, so I'll just jump through this pretty quickly. But before that, just same disclaimer as Joe at the front end, and then US disclaimer for US viewers. Just quickly going through it. These will all be over a 2-week period after being off last week. So 1 box increase for the S&P here. Really not a lot of movement, obviously. Back to this resistance line from 2 weeks ago. You can see it reversed and then reverse that reversal, which is a positive sign for the S&P, just creating that short-term support after really melting up over the past 6-7 weeks. Year to date, it's up about 9%. Obviously continues to being led by AI and semiconductors. Really seems like a concentrated market once again compared to last year. Vertical price objective moved up even further this week. And then the overbought oversold 91%. That's the 4th straight week above 80%. You'll see a bit of a trend here, really heavily elevated. Perhaps the signs of a bit of a reversal. This demand that we've seen really not sustainable, I'll say. Looking here at the NASDAQ, kind of similar move, 2 column changes over the last 2 weeks. This created its 2nd straight buy signal, to an all-time high once again. The NASDAQ 100 is up now about 19% year to date after really just melting up over the past, I guess, 8 to 10 weeks now. Really this week being led by Micron, which surpassed a $1 trillion market capitalization. So the AI trade full on. You can see the overbought oversold 114%. That's the 4th straight week above 100%. The S&P was, I said, at extreme levels. The NASDAQ 100 is at even higher levels. So potentially a pullback in demand or correction territory, or at least a small correction, perhaps. Just all these technical indicators are at extreme levels. The RSIs, the momentum, that overbought oversold metric that we use. So just something to note there. Looking here at the Dow, a little bit of a different story. Had 3 column changes over the last 2 weeks. It created a new buy signal, which is the 5th straight, which is The fifth straight since the market's rebounded since the start of April. That's the first time we've had 5 straight buy signals for the Dow Jones since 2014. We've had a lot of fours. I went through all the data. You can see there were a couple fours last year. There's actually two, one here after Liberation Day, one in the late summer / early fall. I think the Dow is the best setup amongst the US indices just because of all those support lines that it's created on the way up. It hasn't had this pure melt up. But like I said a couple weeks ago, the dispersion between growth and value continues to accelerate. That's still true today, with the AI companies and the semiconductors really exploding. That kind of continued this week, but you can even see on the overbought, oversold, the Dow lagging behind. Even on a momentum basis, the Dow is trading in negative monthly momentum for the third month straight. So still some weakness there. We'll see what happens in the coming months. Looking here, the TSX 60, not a real large change this over the last 2 weeks for it. $3 increase, created second straight buy signal. There has been some weakness in the energy names over the last week, specifically stemming from the uncertainty in Iran and U.S. policy, but nonetheless, a lot of those names still up here to date. But there was some strength in non-energy commodities over the last week, especially for the TSX components. Overbought, oversold, 9th straight week overbought. 47% this week, so lagging the U.S. indice by a large margin. It seems investors have rotated back towards U.S. equities after seeking perhaps some diversification last year. Looking here at the VIX, 2% decrease week over week. Did create a new sell signal, so continues to break down, but it hasn't broken down past this level it created 2 weeks ago. We'll have to see if it continues to move lower or if it reverses this trend that we've been in for the past 3.5 months in this downtrend. Looking here at the bullish percentage chart. So like I said, obviously markets at all-time highs. Both of these charts moved lower. Percentage of companies trading in a bullish pattern fell, both sitting around that 50% level. Why is that? And the market's at all-time highs. Lack of breadth. Semis leading the market. AI companies leading the market. So kind of further confirmation of that. And then percent positive trend. The NASDAQ pulled back another 6% here. The Dow is still remaining in the same area. But just looking at the NASDAQ chart, just further confirmation bias of the I guess lack of breadth in the market. Looking here at the Toronto Stock Exchange technical indicators, neither of these changed, so I'll just jump through them pretty quickly. They haven't changed in a few weeks. And then looking here at the asset class rankings, this is over 2 weeks. Large cap growth did pick up 5 buy signals, kind of coincides with a lot of that. Those AI hyperscalers, those mega caps, those aren't really the names that have led the market, I'd say, over the last week, but still having some strong returns in some of those names. But you can see here tech, just a few weeks ago, was sitting at 175 buy signals. It's now sitting at 232 and approaching energy for the first position amongst the sectors. And there's a massive dispersion after those two sectors. So obviously energy benefiting from the war in the Middle East, and tech continuing to benefit from investor hopes and investor sentiment regarding AI. And then down here in currencies, the US dollar actually picked up 2 buy signals over the last 2 weeks. It's kind of the most even I've seen the currencies in quite some time, where they're all sitting at between 22 and 21 buy signals. So something to watch there moving forward. Just wanted to highlight a couple slides. This is the S&P 500 earnings yield versus the 10-year and 30-year Treasury for the 10 and 30-year instrument. And then down here is the equity risk premium. So the S&P 500 earnings yield versus the 10 and then the 30-year. You can see which lines are which in the legend at the bottom. Obviously, flipping to a negative ERP implies that equities are offering less yield, which obviously signals a diminished risk premium and raises questions about the attractiveness of equities at current valuations. Nothing that we've never heard of, but quite a long period really where the S&P 500 earnings yield it has been below the 10 and the 30-year. There's obviously been blips where they've reversed, but going on about 18 to 20 months of straight period where the S&P 500's earnings yield has been below that of the Treasury yield. Looking here, this is the U.S. Treasury 30-year, in which 30-year rate indexed for inflation. The 30-year obviously hit about 5.15% last week. That's the highest level since 07. It seems obviously investors still worried about inflationary pressure, particularly when you're looking more than 10 years out. Obviously, we've been mentioning inflation and the worries of hedging that and the purchasing power for our investors. For quite some time, we obviously did not foresee some sort of conflict in the Middle East exploding, but we expect some inflation to obviously trickle into the system as we head further and further into this conflict. And the price of energy moving up is going to impact various inputs. I read something this week on where some economists are forecasting the rate of inflation to be closer to the end of the year, and it's pretty wide ranging right now. I think obviously a lot of them are still jumping into the data, but still we think it's going to be a problem. And then obviously not just a problem in the US. This is a G7 10-year government bond index, highest level since actually 2004 now. The US highest level since 2007. So inflation worries obviously not just a US problem, impacting the rest of the world. And it's going to be interesting to see how these higher rates continue to impact equity markets for one, and even domestic housing markets. Looking here, crude up 63% year to date. I just wanted to show the point and figure chart sitting at a line of support. Really been volatile the last few weeks. We think right now perhaps we'll stay in this range. The $120 oil probably unsustainable at that level, but oil trading in the high 80s, low 90s, not demand destruction zone, but really strong cash flows for a lot of these energy producers. So we're really happy with where our portfolios are set up right now in terms of energy exposure. And then the next few slides are just glimpses into the overall market and indices. And this first one is looking at the date each of these firms reached a $1 trillion market capitalization. You can see Apple, obviously the first back in 18, Walmart the most recent, other than Micron, which joined that club last week. And you can see at the bottom the estimated 30-day, which is a little weaker at about 1.3%. And then the 1-year performance at about 41%. So watching that obviously very carefully, but you can also see the overbought, oversold for Micron was actually the highest other than Tesla and Meta. Those two had the highest overbought, oversold for a company when they reached that $1 trillion market capitalization. Tesla, no surprise, kind of a cultish following from investors. Meta, I think that was early 2024 was when a lot of those hyperscalers were benefiting from the original days of the AI trade. So Nonetheless, really interesting slide there. And then kind of coinciding with what we've been talking about here. Here's the tech sector and its industry weightings within the S&P 500. So obviously today, or as of the end of April, the tech sector makes up about 35% of the S&P 500. Going back to the end of 2022, after the 2022 bear market, that was only about 22%. We've almost increased by 50% in the matter of 3.5 years. And you can see here at the bottom, these are the exposure to 4 sub-sectors of the tech sector. You can see obviously the dip in terms of the software exposure, but then you can see the massive increase where there's been at least a triple over the last 3 years in terms of exposure. 17% of the S&P 500 is now exposed to semiconductors. At the end of 2022, that was 5%. So kind of what we continue to talk about, the risks of passive investing in today's market, the over concentration in these massive ETFs, obviously with the concentration in the hyperscalers and the AI companies. And you can see here, this is the industry weightings within the actual tech sector. So right now, about 48% of the tech sector ETF from iShares, that's what this tracks, is semiconductors. And then you can see tech hardware has kind of been flat, I guess, going back even 7 years. Software's substantially dipped over the last 3 to 4 years, no surprise. And then electronical equipment has been really flat at 2%, dating back to 2016. But really just kind of drilling that point in about concentration and just the mega caps. And speaking of mega caps, obviously SpaceX and space stocks are kind of all in the news right now. Could be the biggest IPO of all time, could force a lot of these indices and passive investors to purchase a substantial portion of SpaceX in the first 6 months. The NASDAQ's changed their weighting system. The S&P's looking at doing that. The FTSE Russell has, I think they just announced this week that they voted to change their index weighting classification for IPOs, and where they'll have to allocate towards companies like SpaceX and potentially OpenAI quicker. So could be a mass rush into these names, but there's also a mass rush into them at quite the multiples. If you look there right now at the chart, this is from Bloomberg, and they're just reported from insiders. So we'll have to see if what the actual valuation comes in at. And then this is an interesting slide from the Globe and Mail this week, looking at mortgage payments and Equifax. There's more Ontarians missing their mortgage payment, as delinquency rate has jumped about 52% over the year in Ontario. Could be a sign of things to come. Obviously, economic conditions have been tightening for quite some time, but really hasn't had that mass impact yet. It's obviously impacted the housing market, all while equity markets remain at all-time highs. So we're going to have to continue to watch that and see if that really trickles into the equity markets or financial markets as a whole. And yeah, I think that's it for me. So I'll pass it over to Chris Curry or Gilbert or whomever.
I was chomping at the bit a bit when Ken was speaking, because talking about inflation, PCE numbers just came out this morning. So if we could create something on the screen that says "not yet" for Ken's and really everyone out there is probably rightly so thinking that more inflation. But anyways, to the economic release this morning, year-on-year inflation was right on the estimates, PCE core at 3.8%. But the surprise was the month-over-month number came in at 0.2, and there was a 0.3 forecast. So a little bit below and well below what I call the terror number, which is 4%. So we're close. I mean, we're up there at 3.8, but not right at the a little ways to go to the terror number, which really I think is at the back of everybody's forecast. Bond market, no change on that move at all. And other interesting stat was GDP second estimate for Q1 came in at 1.6, so lower. So perhaps that's the stagflation. The estimate was 0.2. But if we look at forward-looking statistics like the Atlanta Fed GDP now, it's got a Q2 forecast in the US of 4%. That's an eye popper, I gotta say. Other things I just want to point out in terms of rate hikes. US rate hike there was one hike forecasted for Q4 of this year. That's been pushed out to Q1 of 2027. And the same in Canada, we had a hike penciled in for October. This is on market-based futures pricing. It's been pushed out to December. So, the market sort of pushing out the expected rate hikes. I mean, the 2-year still well above the median of the Fed funds rate, which is 3.5 to 3 3/4. So median point, 3 5/8 there. 2 years over 4, as we all know. Lastly, just want to finish off two things. One, Canadian dollar has had a big sell-off, which I'm sure you guys have all noted. But Ken had a really interesting chart and discussion about interest rates around the world. And I wanted to highlight for people that may not be following it, but Turkey is the latest, what do you want to call them? The latest gong show there. And their rates are, unfortunately, I can't pull it up right now. But, I think their rate structure is in the 40% range. So long rates, 10 years longer rates at 40%. So, I'm not sure what's going on in Turkey. I don't know if anyone else can help out, but that's something that, and I imagine the currency's taking the full brunt of that. But on that note, it's over to Gilbert.
Okay, thanks, guys. I'm just going to have a quick short report here today. Here's a disclaimer. Hope everyone can hear me. S&P 500. This is now, and correct me if I'm wrong, I think this is the 8th week in a row of a positive move in the S&P 500. I think 2 weeks ago, I showed this table here from Carson Research, which just shows that when markets, or at least when the S&P 500 moves higher 6 weeks in a row, it's positive 4 weeks later, 12 weeks later, 26, and then obviously a year later. And these numbers are actually quite eye-popping, which is around 30%, at least the last 4 times. It was around 30%. Previous to that, the average is around 17% higher when you have 6 weeks in a row. Well, if the current rally holds up here, we're going to have 8 in a row. And Carson did provide this other table as well, which shows that, again, when you have 8 in a row, what do you get is you get a lot more from there, and the average, or at least the median, being around 20%. So an odd market that we're in, but this rally just looks very powerful and it's continuing. That being said, we take a look at the CAPE ratio. We're now essentially right where we were at the heights of the dot-com bubble, right? And it doesn't matter how we got there or whether it was different from 2000, but cyclically adjusted price to earnings are now really at that same level that we saw in the peak, and we know what happened subsequent to that. Ken was talking earlier about breadth. That's right, we're not at market extremes when it comes to breadth right now, which suggests that there's probably some more room to run in terms of participation. This is S&P 500 stocks trading above the 50-day moving average. We're not at the extreme levels that we saw at the start of the year, which again I think were a factor in the sideways and market and pull down that we had before the rally. Same thing with stocks trading above their 200-day exponential moving average. We're not at any extreme levels that really would suggest that there's not a lot more room to run, and that corroborates what we were talking about earlier with the previous chart. Finally, defense versus growth, looking all the way back to 2000. Yeah, we're almost there. We're almost at that level of growth outperforming defense or staples that we saw in 2000, and we know what happened subsequent to that. So if you're a viewer and you're concerned about any of that, please reach out to us. We have a solution with our partners at Universa, and we'd be glad to talk. That's it for me this week. Anybody else? No, going once. All right, I think that's it. So good day, everyone. Take care.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnichollasset.com to learn more.